My name is Jake. Welcome to the channel. What you see here on your screen is my M1 Finance portfolio. I've been investing into a dividend growth strategy for a little over a year now. And it wasn't until about middle of last year, about May of 2019, is when I transferred my Robinhood portfolio into my M1 Finance portfolio, that which you can see here on your screen. And I did that for a couple of reasons. I did it because I feel that M1 Finance is a little bit more tailored toward dividend investors, especially investors that are looking to invest for the long term. I've noticed there's going to be pros and cons with every brokerage. If you go and you search anything around dividend investing, brokerages are, that's always going to be a topic of discussion. Everyone has their own opinion. But me personally, when it comes to dollar cost averaging and just putting your portfolio on autopilot, I'm absolutely a huge fan of M1 Finance. I love the fact that you can build your own portfolio. I kind of like to think of it as building your own index, building an index for free. Now, when you think of it, an ETF or an index fund is nothing more than just a bundle or a basket of different companies all bundled up, and you buy that single basket at a singular price. Now with M1 Finance, I'm able to do that and create my own ETF or my own index fund for free. Now I'm not here to say that I am going to beat the market or I am more capable than the fund managers over at Vanguard or BlackRock or Fidelity or wherever. But what I'm saying is I'm able to take control of my portfolio, and I absolutely love that. If you're looking to buy and sell individual companies, stocks, or ETFs at a specific price on any given day, you're probably better off with a different brokerage. M1 Finance is not really designed to buy and sell, trade individual stocks. It's just, in my experience, it has not been the most favorable experience. And it can actually lead to a lot of frustration. I know a lot of people that are trying to trade at a specific price or any given day. They've had a lot of frustration with that. That's why I would recommend using a different brokerage if you're looking to do that. I personally use Vanguard. I use Vanguard to purchase specific companies at a specific price through limit orders. And yes, with Vanguard, you can do that commission free now. That's something that they've rolled out here recently. You don't have to just purchase Vanguard funds, ETFs, or mutual funds. You can actually purchase anything on the exchange commission free. Pretty cool stuff. So for the remainder of the video, what I want to do is I want to review a few subscriber portfolios, and I want to share with all of you kind of my thoughts and opinion on some of the portfolios that were submitted here this week. So earlier in the week, I sent out a post here to the community. If you would be interested in me reviewing your portfolio, I'd be more than happy to do so. And really just keep in mind, I'm just a guy here on the internet. I'm not a financial advisor. These are just really my opinion on your portfolio. And for those of you obviously that follow the channel, you know my investing strategy. I'm investing for dividend growth. I'm looking at this from a long-term horizon, and really the ultimate goal here is to grow cash flow or passive income to supplement your living expenses and really achieve financial freedom. That's what it's all about. That's what I've been talking about on the channel since day one. Okay, and the first portfolio that I want to review is from Taylor. Taylor writes here, "Hello, first I'd like to say I really enjoy your content and other dividend investing or investing channels in general. I'm 24, out of college since last summer, and deposit about $500 a month into my M1 Finance account. I started with the M1 account just after the first couple of days of the recent crash, and I have almost $3,000 in Robinhood, but decided now was a great time to start a new portfolio using M1. My goal of this account is to grow the dividend and eventually use this income later in life as I see fit. But for now, want the dividend to snowball and this is in a taxable account. This is your portfolio over the last 5 years, up 32%. This is actually really good compared to other portfolios. If you look at other indexes, they're only up a couple of percentage points. So when I see that, I automatically know that there's going to be a lot more growth in this portfolio. So the dividend yield, just under 4%. Now, if you were to look at this about a couple of months ago, I'm sure that this was probably hovering a little under 3%. So that's really great to see that this is up. 54 holdings, so there's quite a bit of holdings in here. The expense ratio is at 0, so there's no ETFs, it's just individual companies. So this is how you have it broken down. So you have REITs at 18%, consumers at 17%, industrials 15%, telecom, retail, technology, and finance. So you don't have utilities, you don't have materials, and you mentioned that you're growing it out. Okay, I think slow and steady wins the race when it comes to this, especially when you're first starting out. And to do your research, this absolutely takes time. You kind of have to, it has to be a hobby of yours. It's not something that you just kind of pick once and throw it in there and then that's the end of it. You do kind of have to keep up with your portfolio. So let's take a look and see what kind of companies you have in your REIT slice. Realty Income, really, I think this is a fan favorite here, especially because they pay a monthly dividend. Store Capital, Boston Properties. I own 4 of the 5 here. I don't currently own IIPR in my portfolio. I do have Store Capital. This is a good one. Also owned by Warren Buffett. Realty Income. I know this is a really hot topic right now. If Realty Income does not cut their dividend, I think this is going to be a great buying opportunity. Especially, we haven't seen these prices from Realty Income in a long time. It's just been so hard to get into a value price in Realty Income. I think right now might be your opportunity. If they don't cut their dividend, this could be a once in a generational opportunity, at least here in the last 10 years. I think once in a decade opportunity with Realty Income. Consumer goods, 14 in here. Coca-Cola, love it. Pepsi, love it. Texas Roadhouse. I think this one is a little bit of a riskier play. It's kind of like my Darden restaurants with the Olive Garden. It's just kind of hard to say. I mean, they're going to temporarily suspend their, if they already haven't. I haven't looked into them. Let me know in the comments section below if they've already suspended their dividend. I couldn't imagine a world where they don't suspend their dividend. Procter & Gamble, absolutely great, recession-proof play. McDonald's, great. Starbucks, great. Marriott, I also own Marriott. They suspended their dividend. I'm not going to be removing Marriott. If anything, I'm going to be adding to my position. Once this, the reason why I've shared this in the past is this is no fault to Marriott. I mean, they did not do anything to deserve this. It's not due to lack of management or negligence or whatever. I'm still sticking with Marriott. General Mills, this is a good one. Instead of General Mills, in my portfolio, I have Kellogg's, but really it's a great company as well that I could own just as well in my portfolio. Budweiser, I think this is a good one. Another one that I've looked at is TAP. I don't personally own alcohol beverage stocks, but not due to any personal reasons, just I just don't currently have them in my portfolio. Colgate, huge fan of Colgate, a great dividend paying company. Nike, own that in my portfolio. Great. Honda, this is really interesting. I used to own a Honda in my portfolio in Robinhood. Before I moved over to M1 Finance, I actually owned Honda. I ended up separating or selling out of Honda shortly after here when I started my M1 Finance portfolio, simply because of all the uncertainty and the unknowns with the auto industry. I personally don't own any automobile stocks. It's just something that's so difficult for me to predict, and the track record and the history is just so shaky. For me personally, I don't own them. I think for current dividend, for current yield, they're it's a something to consider, but it's not something that I personally own at the moment. Going down to industrials, 8 in this slice. I love to see that you got Waste Management in there, my favorite industrial stock in there. UPS, love it. Lockheed Martin, love it. Caterpillar, 3M, love it. Delta, going to be a little bit interesting to see what goes on, what happens with their dividend long term. Rockwell, I don't have that in my portfolio. I just recently separated from Boeing, but it could be, they're likely going to see a turnaround. It's just the uncertainty with the dividend, what's going to happen long term. I just wasn't sure. But I love to see your top 3 here. Huge fan of them. Waste Management, UPS, Lockheed Martin, great picks. Telecom, I own 4 of the 5 here. Love Verizon, AT&T, Disney, Comcast. All 4 of those are my portfolio. Target allocation, I agree with it. I think it's good for what you're trying to accomplish. I like it. Retail, I own 3 of the 5 here. I don't currently own Lowe's or Home Depot currently. I'm looking, if I were to pick one of the 2, I think I would probably go with Lowe's simply because I like the lower payout ratio and the dividend history of Lowe's a little bit better. But, I think both are actually great. Walmart have in my portfolio, Target, great, Costco, great. Technology, Intel, Microsoft, Apple, agree with all three of those. Those are absolutely great. AMD, I think, is interesting. I personally like NVIDIA a little bit better personally, but I think AMD, it's been kind of a battle between the two these last couple of years, but yeah, I think AMD could work out as well. Amazon, not a dividend company today. I wouldn't be surprised in the future if they weren't to start paying a dividend. It's not going to be a high dividend to start out with, but if they were to pay a dividend, it's going to be a dividend growth company, and it's going to be growing very, very quickly. Sony, good company. Activision Blizzard, I think right now this is a great pick, especially with everything that's going on. Everybody is staying at home. Financials. Visa, like seeing Visa at the top there. I really like Visa. JP Morgan, great. Goldman Sachs, great. Blackstone, Bank of America. American Express, huge fan of American Express. I'm thinking about adding them as well. So a lot of traditional banks. Berkshire down here, that's great. If looking at this, I think something that you can consider, you got all the traditional banks in there. You got a credit card company in there. I think these are good. Something that you can consider adding as well would be insurance companies like Aflac, for example. Aflac would be a great pick. Also looking at investment companies like T. Rowe. T. Rowe could be something that you could look into long term. But as it stands right now, great looking slice, great portfolio. I like it. So if you're talking about utilities, you mentioned that you were looking to adding utilities. I think adding utilities like Next Era Energy, Duke, AWR, I think some of these, these more growth-oriented utility companies would serve you better considering your age and your goals. So I would recommend, if you're going to do, add companies like Southern Company, Dominion, maybe lower the target allocation, but have a higher target allocation towards those growth-oriented sectors like Next Era Energy and AWR. So that's my feedback on the portfolio. Overall, I think it has a great starting yield. I think it's something that's manageable. 54 holdings, very, very manageable, and a lot of very well-known companies. Great portfolio. Okay, so the next one is going to be from Raphael. He says here, I've started following you not so long ago and recently saw that you posted that you would be reviewing people's portfolios. I would love to have that opportunity. To give you the background, I started investing back in February of 2018 on Merrill. At that time, I just started gambling in the stock market because I had no clue of what I was doing. About a year ago, I decided to sell everything in that account to pay some debt. At the same time, I still wanted to continue investing and came across the M1 Finance platform back in June 2019 and started investing small amounts, about $10 a week. Since mid-2018, I decided to start reading books about finance and the stock market to better myself and not gamble in stocks. I still have a lot to learn since I'm not fully comfortable doing full stock analysis. Currently, my age is 26, and I plan to use this taxable account in about 7 to 10 years to supplement my income and start paying bills. My current contribution is $20 a week, which I've slowly grown and plan to keep growing. Well, hey, Raphael, first off, I think a lot of people are in a very similar situation as you. When I first started investing, when I was right out of college, right at the beginning, when I first started college, I kind of played a lot with the stock market. I started investing on margin. It was kind of trial by error. I wish I would have started with paper trading, trading with paper money, like not real money in the account. That I think would have helped me a lot more, and would have softened the blow when I lost my actual money. But I think, the fact that you're starting to learn, you're starting to read, do your research, that is the very first step that, you're right on track. You're exactly where you should be considering, where you're at, because you don't learn about finance and investing in school. This is not something that you learn. Right? And so the fact that you're taking the initiative and doing this, I commend you on that. I mean, that's absolutely amazing. And the fact that you're paying off your debt while still investing, you're managing your finances, it's really the responsible thing to do. And I'm really excited to review your portfolio. All right, so let's take a look at your portfolio here. Over the last 5 years, you're down about 6%, so a little bit in line, more in line with the market. I see you have an expense ratio here, so you're investing in a few ETFs, dividend of a 3.5%, holdings 88 holdings. So there's quite a few holdings in here. If you're first starting out, this is going to be a lot more hands-on than if you were just to invest into a couple well-diversified ETFs. So really keep that in mind, right? If you have 88 holdings and you're first starting out, right, you really want to do your research and make sure that, you're investing into high quality companies, especially if companies that, you see your portfolio go down, you want to be confident and know that, okay, if you're investing into a company that you're confident to still average in when you see the price go down, because the emotional impact is so important there, especially right now as we're entering this bear market. That's going to be more important than it has been over the last 10 years of a bull market. Okay, so let's take a look at it. The first index or the first slice is going to be in indexes. You have 6 indexes in here. It looks like your 31% is just in international companies. Okay, interesting. VEU. So this is there's no exposure to the United States. All right. VTI. This is just the United States. Small cap here in the U.S. VUG is also another. It's a good one for dividend growth. VOO. I think this is good. One thing that you want to be careful of, I think, something that I've seen myself do is you want to be careful that you don't want to play around with it too much. You don't want to adjust the target allocation. You don't want to add and subtract holdings, every single week, every single day. The real value of dividend growth investing is really invest into high quality companies or vehicles like ETFs and really put it on autopilot as much as you can. Okay, let's take a look at your REIT sector here, the REIT slice. Okay, I really like how you set up the majority of your target allocation into VNQ, the Vanguard Real Estate ETF. I really like that you have Welltower. It's a good health sector REIT. I know that they've been hit pretty hard here in 2020. The health sector in REITs have really been taking a big hit with VTR, Welltower, MPW, NHI. You have a lot of these. I think there's a lot of growth opportunity over the long term, but this is going to take quite a while for this to turn around, I think. I think the healthcare sector in REITs are going to they're going to come around, but it's going to take a couple of years. Right now, what's doing really well is storage units like public storage, PSA, it could be like EXR for extra space storage. Those are really doing really well, as well as your data centers. For example, DLR. DLR is doing really well. But I think your portfolio, I think this is fine. I think this is not overcomplicated. I think this is pretty straightforward. My only comment here would be to maybe limit your exposure to one individual sector within the real estate, the REIT sector. That's my main feedback there. Technology, 5 slices. Once again, the VGT here, I really like seeing that. Alibaba, Microsoft, Apple, great. I think these are absolutely fine. Healthcare, also you got VHT here. Now you're going to see overlap. I'm assuming, I haven't looked at this before, but I'm assuming that this is going to be similar throughout your portfolio. You're going to have a little bit of overlap, which is completely fine considering how you have it set up. I do like the fact that you're invested into quality. I do like that you have your industry-specific ETFs at the highest target allocation. I think that's going to be really good. Do you really need all the other ones? I think this is to everyone there. Everyone has a different approach. I have a similar strategy when investing. My only opinion here is understand these businesses. If you don't know what MDT does and BDX does, you might want to consider putting more exposure into VHT. If you know exactly what these companies do and you follow these companies, I think this is the right approach. One thing that you don't want to do, you mentioned that you're new to investing. What you don't want to do is you don't want to I can see that you spent a lot of time and put a lot of thought into setting this up, and I think this is actually absolutely great. The only thing that I'm somewhat concerned about is because you are a new investor, this is very new, you may be changing your mind a lot. You may be adding and subtracting from your portfolio a lot, and that's something that you really want to try to avoid the best that you can. So if you're doing your due diligence, you're following up on these companies, I think this could be a great opportunity for you, the way that you have it set up. But your biggest enemy is going to be yourself, your emotions. So really keep that in mind. Finance sector, very similar. I love this. This is probably one of my favorite slices that I've seen so far. I love it. I love how simple it is. 70% into VFH, huge fan. Wells Fargo, Bank of America, AXP, love it. Consumer staples, very similar. Let's take a look. Coke, Clorox, these are great. These are great. You really can't do wrong with any of these. Kraft cut their dividend recently. Walgreens is in a little bit of trouble considering everything that's going on, but the majority of these here, almost all of them I own in my own portfolio. Pepsi, Procter & Gamble, Hormels, Kimberly-Clark, Kellogg's, Clorox, Coke, the majority of them I own in my own portfolio. Love it. Consumer discretionary, love it. The only one, Carnival, I think this is a little bit of a more riskier play, but you know what? It's only 10% in this slice. I think you're going to be okay. I like how you have your target allocation where it gets lower and lower. Technology is good. When I'm looking at this, when you say that you're in your mid-20s and you're first starting out, I want to see more in your technology slice. I want to see this at a little bit of a higher percentage, personally. I think you could even bump this up even a little bit more. Let's see here. Communication services. Fox, great. I do like how you're setting this up. I like that you're using the industry specific ETFs here. I think this is really smart of you to do that. I really love Disney, Verizon, AT&T. One that you can maybe consider adding here would be Comcast. Comcast is a really good one that I hold in my portfolio. Bonds. You only have 2 bonds here. If you're going to go with bonds, I think these are some of the best bonds that you can go with. Having only 5% allocated, I love it. Utility sector, this is only 4%. This is maybe something that you could consider bumping up a little bit more. Utility sector, let's see here. You got Duke, NextEra Energy. This is the one that I was talking about for Taylor. NextEra Energy, Duke. These are 2 really great ones. This is also a great one. Yeah. I love them. I love all of these. Great. All right. Industrials. Okay. All right. Vanguard Industrials ETF, Waste Management, Caterpillar, 3M. Love it. Boeing, there's kind of a question mark here. What's going to go on long term with them? But as a whole, I love it. It's great. Energy. Energy is obviously going to be a little bit riskier. There's a reason why it has 11% of a dividend yield. Occidental. I don't know about this one. They just barely cut their dividend. Chevron, I'm a big fan of Chevron. With oil, you really want to focus on quality when it comes to the energy sector. I would really focus on quality. And for me, quality of the bunch here, Chevron really takes the cake. In my personal opinion, I think if you're going to invest into energy like this, I would increase VDE up even more. I would allocate more to VDE, and I would allocate more to Chevron. Up that, I would say, just as a kind of an opinion here, I would put 60% into, the Vanguard Energy ETF, and I would put maybe 20% into Chevron, and then break down the rest into smaller percentages. That's just my opinion. And then, obviously you could also have ExxonMobil up there a little bit more, and then have BP and the others at a smaller allocation. But all in all here, Raphael, I think this portfolio, I know that you put a lot of thought and a lot of effort into this. I think if you hold this long term, you're going to do extremely well. Focus on continually adding dollar cost averaging into your portfolio. Focus on cutting your expenses, side hustling, finding out new ways to get, gain or grow your income, your active income, so that you can invest more on a weekly basis. And I think really the big risk to your portfolio here is going to be yourself, your emotions. So really, when you're doing research, when you're educating yourself, understand the importance of your emotions and how that can impact your investing decision making. But overall, love it. I love what you're trying to do here, and keep doing it. Okay, let's take a look at the next one. Hello, Jake. I have so much free time during a boring quarantine that I thought, why not get your opinion on my pie? I'm currently 20 years old, and as any other 20-year-old, I really want my dream car, a BMW M240i, and I'm trying hard to get my dividends to pay for all the cost of buying one. But in the long term, would really like to retire solely from dividends. I have a taxable account with monthly contributions of $1,000. Here's the link to my pie. I hope you can share it on your channel. Thanks, Jeff. First off, I used to actually live very close to the BMW headquarters in Munich, Germany. So very familiar with them. If you're saving or contributing $1,000 to your portfolio at the age of 20, that means that you have your expenses under control and you have a well-paying job. So that is really, really great to see. So let's take a look at your portfolio. All right, so it looks like your portfolio has 35 holdings in it and it's yielding over 6%. So 6%, that is a really good starting dividend yield. Now, if I were to look back a couple of weeks ago, that was probably yielding anywhere around 4% would be kind of my guess, maybe a little bit under 4%. All right, so let's take a look at it. So it doesn't look like you have it broken down into individual, sub pies, but you have it just very straightforward here in 35 slices. Okay, so you have 25% allocated to Good. Good is a REIT. It pays a monthly dividend. I also invest into Good into my portfolio. Another one at 10% in Realty Income. Now, Realty Income, this one, we talked about it a little bit earlier, but this one is really interesting because if they come out of this crisis on top, this is going to be a once in a decade opportunity to get into Realty Income. It's a little bit risky, but if they come out on top, they're going to do really, really well. Okay, so the next one, TD Bank. I'm a big fan of them. Royal Bank of Canada, fan of them. CM. So it looks like you're out of Canada, I would assume, if you're investing into these banks. The reason why I don't invest into Canadian banks here in the US is because of the international tax that comes with that. That's why I prefer American banks as a US citizen paying US taxes. Bank of Montreal, I've also heard really, really good things about these. So these are really, really high quality banks in Canada. Great picks. Next Era Energy, one of my favorite utility stocks. Waste Management, for those of you that follow the channel, you know I love Waste Management. Starbucks, big fan of Starbucks. I don't personally own Starbucks in my portfolio, but I think this is a great company. Instead of owning Starbucks, for me personally, I own McDonald's, which I can see you also own. RSG is a great waste management company, similar to Waste Management. They're going to be around. I also own them in my portfolio. Great company. Costco, great. Colgate, great. AT&T, Microsoft, Apple, great. BNS, I'm not familiar with BNS. I'd have to do some research on them, but I couldn't add my opinion there. Disney, love Disney. 1% I think is a little bit low personally. I think 1% could be a little bit higher considering your age. If you're 20, I think you could up this up a little bit. Walmart as well. I think you could up this a little bit more. Stag, also another great monthly paying dividend REIT. Shaw Communication, this is another good monthly payer. USB, it's a US bank, good one. PNC, a good one. Pepsi, also a really good one. 1%. So this is really interesting. I think it's interesting. This is kind of more of like a traditional ETF. Now, if you were to go look at an ETF on ETF.com, you go look at like VOO or an S&P 500. Typically, the way that it works is the top 10 holdings are weighted the most or the highest. And then when the further you get down, the allocation just really drops off. So this is kind of allocated that way, which I think is really interesting. You're still getting exposure to Johnson & Johnson, Coca-Cola, these other great companies, AMT, good to see that there, Ali Bank, great. You're not going to have so much fluctuation from these ones, you're going to see a really big swing in the investments up here. Now, you have a lot of exposure to REITs. I'm not familiar how REITs are taxed in Canada. In the United States, they're taxed a little bit less favorably, but not so much where I don't think that it's not worth investing into them, especially in a taxable account. Now, obviously, if you could invest into them in a tax-deferred account or tax-sheltered account, you would be better off. But there's also a trade-off, right? Because you're not going to be able to leverage the investments or the dividends in that portfolio until you reach a certain age. For example, in the US, that's 59 and a half. So it really comes down to your strategy. Now, knowing that you're looking to pay for your living expenses here in the short term, in the next couple of years, maybe 10 years, I think this could be something really, that could work out for you. But once again, this is kind of a very ambitious portfolio where you're putting a lot of your eggs into good and realty income. Now, I don't know your risk tolerance, but looking at this, you have to be aware that you're going to see a little bit more fluctuation, with your portfolio here over the next coming months and years, right? But once again, if these work out, these are going to be a great investment for you long term. So overall, really like the portfolio. I like how you have it set up. I think for me personally, given your age, what you could consider is analyzing which companies are growing their dividend the fastest and allocate a little bit more towards those. For example, having JP Morgan or AMT, companies that are growing their dividend a little bit faster than maybe a Coca-Cola, you could adjust the target allocation a little bit that way. Right now, you're looking for a current yield, which is, right now the entire market is yielding very high because we've seen such a huge, massive pullback. But I think it could work out for you. So really cool portfolio. Here, before I forget, actually, Jeff, one thing that I would recommend you take a look at, given your portfolio, the way that you have it set up, you have a lot of monthly payers in here. One thing that you could look at is one ETF is SPHD. SPHD has over a 6% dividend yield currently, and they pay a monthly dividend. It has a little bit of a higher expense ratio that you're paying for quality here, and also you're getting that monthly dividend. That's why the expense ratio is a little bit higher, but definitely take a look at it. SPHD from Invesco. It's something that I'm considering investing into in the future. It's not something I invest in today, but it's something that I think would fit very well into your portfolio and into your strategy. I hope that helps. Alrighty, the next one is going to be from Moki Finance. He's another YouTuber here on the in the investing community, and he writes here, I watch your videos rigorously and have been inspired to start my own YouTube channel. Thanks for sharing your thoughts on my pie. So Moki is 30 years old. He'd like to create, average monthly income through dividends of $1,000 by the time he turns 40. I really like that. I like that you have a specific goal and a time frame there. I plan to use the dividends as supplemental income in my early retirement. Okay, love it. Individual tax account, so it's not in a deferred account, a tax deferred account. He's currently contributing $400 a month with the goal to up the contributions by $100 every 3 months. Okay, I like that. I really like the fact that you have specific goals. If you don't have specific goals, it makes it very difficult for you to navigate where you want to be. Imagine you're going on a road trip, you don't have a map, you don't have a GPS, and you're just getting in the car and you're just driving somewhere. You really don't know where you're going to end up unless you have a goal and you have a map and you have a plan. I've shared other videos on that in the past, but I think that's really, really important. And I like that you mentioned that here, Moki. Okay, Moki, so let's take a look at your portfolio. Okay, so your portfolio, you currently have 20 holdings, have a little bit over a 4% dividend yield. I think this dividend yield has also changed dramatically here over the last couple of weeks, like everybody else, right? You were probably getting a little bit over a 3% dividend here just a couple of months ago. So this is a great time to start investing into your portfolio and averaging down into your portfolio. So let's take a look and see what you got. I like it how you have it equally weighted. You got 5% equally weighted into every single one of your holdings. Let's take a look at it. Target in your portfolio, love it. I'm a huge fan of Target. T. Rowe Price, great financial company. Pepsi, Realty Income. I love it. I think every single one of these on the list here so far are in my portfolio. Absolutely love it. Johnson & Johnson, great. Emerson Electric Company, great company. If I'm not mistaken, a Dividend King, as well as Johnson & Johnson. Chevron, great Dividend Kings right there. Caterpillar, great. ED, great. AbbVie, 3M, Coca-Cola, ExxonMobil, great. Every single one of these companies are in my portfolio. I love it. So here, let me add a little bit of context. I think if you're just starting out, if you're 30 years old, you're trying to, build a passive income stream, I love how straightforward and simple this is. This is a low maintenance portfolio. These are all very well established companies across every sector, if I'm not mistaken. I don't think I see Disney in here or Comcast. Well, yeah, okay, you do have communications in there, telecommunications. So you're very well diversified. It's very low maintenance. Something that kind of comes to mind. Now, I think that if you kind of come across similar to me as kind of a dividend nerd, where you're interested in this type of investing strategy, it's kind of a hobby to you, I think this is an absolute great portfolio. This is a very high quality portfolio. This is quality over quantity. I love it. If someone were to be watching this video and thinking, okay, how can I invest into this strategy, but I don't want to invest maybe so much time or energy or effort into following up onto these companies, something that you could do is you could invest into an ETF that follows or tracks a similar strategy to this. Something that you could invest in that is equally weighted, for example, in Noble. The ProShares ETF, Dividend Aristocrat ETF, ticker symbol NOBL, Noble. You get pretty much the exact same kind of strategy. However, you're not going to get as high of a dividend yield like you have here. So this is a little bit more heavily skewed towards a higher dividend, which I like. Now, if you're in your 20s, Moki, I would say you would maybe want to adjust the target allocation, skew it a little bit more towards your higher growth companies like a Microsoft and Apple, for example. But given where you're at in your 30s and you have maybe a 10-year time horizon, I think this is an absolute stellar portfolio. I think you're absolutely on the right track. So love it. Great job. Okay, the next one is going to be from Kyle. So Kyle writes here, so my goal is to build a dividend growth portfolio that'll build its passive income potential to live off of, or at least be heavily supplemented by, in the ballpark of around 15 years or so. I have a stable income, so I'm depending on the drip to grow my portfolio to the highest potential before I decided to use it. Okay, great. As I'm new to investing, I'm not confident in my ability to pick stocks, so I shifted the ETF stock split from 50-50 to 60-40. In the stock selection, I played around with the distribution of 11 stocks, hoping to focus more on dividend growth rather than current yield. So my questions are, do you think my current pie distribution makes sense for my goals? If I don't have enough time to research stocks, would you suggest I shift even further towards ETFs, 70-30 or even 80-20? If so, what changes would you suggest in the ETF's distribution? And lastly, what advice would you have moving forward? Should I set my auto deposits and go completely hands off, or should I keep checking in and making adjustments over time? I personally prefer to have a hands-off approach, as my work can be demanding, but I'll do what I need to ensure I achieve my goals. Thanks again for allowing me to share. All right, well, Kyle, so this is really great. I think that the majority of the people watching my videos or other investing videos have very similar questions or faced with a similar question. I myself was in a very similar situation as well when I first started learning about investing. So let's kind of break down some of your questions here. Do you think my current pie distribution makes sense for my goals? Well, this makes complete sense to me. If you want to retire within 15 years, use the dividends to pay for your living expenses, you need to be aggressive with your investments and aggressive with funding the account. If you want to live off of dividends, you have to have money invested. This starts with earning more money from your job, cutting expenses, and then taking on side hustles to earn extra money to fund your portfolio. When it comes to your next question, if you should be shifting your allocation more heavily skewed towards ETFs in a 70-30 or 80-20 even, this really truly comes down to your personal risk tolerance. The longer you invest, you will always battle with the decision of, am I investing too much or too little into a single asset class or investment vehicle? It's just kind of how it is. You might, you'll battle between, am I investing too much in stocks, too much in bonds, too much in real estate? It's just kind of how it works. It's not really going to go away. Given both slices are generally, nearly identical or have identical returns, if you were to invest into similar companies and dividend growth companies, I think you would be okay long term in either direction, for example, in a 70-30 or 80-20. If you're unsure, if you feel your emotions are causing stress with this decision, I would always recommend siding with a more conservative approach, and that would be skewing higher in ETFs. If you can always adjust this over time. The 11 individual stocks that you have in there, the best out of there, you should be in good hands, right? You're going to have good quality companies in there. The ETFs in your portfolio are also very, very high quality ETFs. I think, and lastly, when it comes to kind of advice moving forward, I think when you're starting out and if you're unsure of, how much effort or energy you should be putting in your portfolio, I would always side on the side of, being conservative. I would skew, in my personal opinion, I would have a higher target allocation to your ETFs and a lower allocation to your stocks. And as you grow and, as your priorities in your life change, you can always reevaluate that. But if you're ever unsure, I would always recommend going with the conservative approach. When it comes to this, I kind of follow the Dave Ramsey approach where, you want to first focus on getting out of debt, getting out of consumer debt, having an emergency fund, and then invest in, this is where I differ from Dave Ramsey, investing in the low-fee, broad-based index funds or ETFs. And then, putting your investments on autopilot. And I think M1 Finance is a great brokerage to do that. So when I look at your portfolio, it looks like you have 19 holdings, you have a 2.8% dividend yield, and you're having 60% allocated towards your dividend growth ETFs and 40% to your dividend growth stocks. This was a pie that I shared on my channel here earlier in the year. If you're just starting out with investing, this would be a great starter portfolio. I love the fact that you're using this and you're asking these type of questions, because this is exactly what you should be doing. Asking questions, trying to understand, okay, what is going to be the best approach for your particular situation? And once again, I would recommend skewing it higher towards the ETFs, at least for now, and then adjusting it as you become more comfortable with investing and become more knowledgeable. So if you look into here, these are great ETFs. These are dividend growth ETFs. I absolutely love these. These are ETFs that I've have invested in or have my wife invested in. I think VIG is a great dividend growth ETF. Along with all of these. These are great long-term investment vehicles. You can't go wrong with any of these, personally. When it comes to the dividend growth stocks, these are some of my all-time favorites: Disney, 3M, Microsoft, Apple, Pepsi, McDonald's, Johnson & Johnson, Coca-Cola, Waste Management, Realty Income, and AT&T. I think these are all are great opportunities here for you. And when it comes to the target allocation, considering where you're at, I still agree with the target allocation. You could adjust a little bit more based off of your risk tolerance, but I honestly don't think you can go wrong with this. So Kyle, I really hope that this is helpful to you. I think when it comes down to this, really the important thing here is understand what are your goals, what are you trying to accomplish, and really make it as simple and seamless as possible for you. Think about it kind of like a 401k with your employer, where you invest every 2 weeks and you just let it sit there and you don't touch it. That's kind of the mentality that I would recommend here. If you don't want to invest the time in following up on these companies, you really want to make it hands-off as possible. Go with the conservative route. I would recommend upping this, personally, in my opinion, I would consider putting this up to maybe 70 or 80% even, and then having this at 20 or 30% for the time being. But I hope that helps. once again, you're doing all the right things. You're educating yourself. You're taking control of your finances, and you're gonna be surprised. When you look back 10 or 20 years, if you stay consistent with this, just how much money you're gonna amass by doing this. All right, this last one, the person requested to remain anonymous, so I'm not going to share their name, but just some overall information. The person is 25 years old. They're currently paper trading with thinkorswim to, kind of learn about investing and grow their, to learn how to invest. And they've came across M1 Finance and are starting to grow a passive income account by adding $200 a month into their portfolio. So let's go ahead and let's take a look at this person's portfolio and see what they have. Currently, they're yielding just under 7%. This is a really strong dividend yield with 16 holdings. All right, the highest allocated holding is going to be SPHD. This is actually one that I was talking about earlier. I don't currently have SPHD in my account, but I think this is a really, really interesting one, and it's yielding it's really at attractive values right now that I would consider picking up myself. ExxonMobil is going to be the second highest target allocation here. I think this is a little bit of a riskier play, but I think, no one has a crystal ball to look into the future and see what's going to happen. This could actually turn out very, very well. If they don't cut their dividend, if they can continue paying their dividend, this could be a really, really great long-term play. VYM, I have this in my retirement account in my Roth IRA. VYM is one of my favorite high dividend yield ETFs. I like VYM and I really like SCHD from Schwab. Really great ones as well. Good from Gladstone here. Also a good monthly dividend payer. Carnival, this one, for obvious reasons, a little bit of a riskier play, something to understand that, they could possibly go bankrupt. It could be that they get bailed out. I think as a long-term reliable dividend payer, this one is going to be a little bit, it's a high risk, high reward. I personally don't invest into Carnival at the moment, and I don't see myself investing into them in the future. But, I think it's very possible that they turn this around, and in a couple of years, they're doing just great. So no one really knows. IBM at 5%, it's a really strong current high yielder. Johnson & Johnson at 5%, 3M, Coca-Cola, Wells Fargo, AT&T, Tesla, kind of cool to see Tesla in there, Home Depot, Chevron, Apple, and Amazon. I think it's interesting that you have ExxonMobil at 11% and Chevron at 4%. I personally, I would flip that. I think Chevron is going to come out of this a little bit stronger than Chevron. That's my personal opinion. I think Apple could also be increased in here as well. I don't see Microsoft. Microsoft is one of the best companies out there today and is a dividend growth company. And given your age in your mid-20s, I think Microsoft also deserves a spot in your portfolio. Amazon, I think Amazon, is a great growth opportunity with Tesla. I think that's completely fine to have that in your portfolio. Obviously, currently not paying a dividend, but maybe they do in the future. So overall, I think maybe adding a company like Microsoft or Visa, one of these hyper growth companies, in there to help increase the snowball effect over the long term, considering your age. Now, if you were in your mid 40s, I think as it stands right now, this is a great mix. Your allocation is set up very well. But given that you're in your 20s, I personally would skew a little bit more towards dividend growth and give up that current yield for the growth that you could be seeing down the road. That's my opinion. That's kind of how I view it. But you have some great names in here with 3M, with Coca-Cola. I think really well-established companies. I think you're going to do well. So really what it comes down to is putting your investments on autopilot, dollar cost averaging, continually transferring money into your portfolio, and enjoy the ride, I guess, is really my opinion there. But once again, I think really my main takeaway here is really look at, considering your age and what you're trying to accomplish, look at the dividend growth. go to seekingalpha.com and look at the dividend growth rate of these individual companies, and then base that off of what your goal is. If you're looking to invest or to retire in the next 5 years, okay, this makes a lot of sense. If you're looking to retire into 10 to 15 years, which is probably more likely, for the majority of people out there at that age group, or even longer, really try to look at or consider looking at investments that have a higher growth, or they're growing their dividend faster. So those are my opinions on that. I hope that this was helpful. And yeah, thanks for sharing. Thank you again, everybody, for sending over your portfolios for me to review. I hope that this was helpful. I thought it was really interesting to see how different people invest into different strategies. And I think it's really interesting. I think there's really no right or wrong way to invest. It really is a personal thing. Everyone's priorities or situations or circumstances are so different. I think it's interesting to see, though, how different people in the community are investing for what I like to see as it's kind of a similar goal in growing passive income, growing cash flow, so that you can one day reach financial independence and retire early, right? That's really what I'm focused on. And I hope that this was helpful. This is the longest video that I've created here on YouTube. If you like the video, if you want to support the channel, please subscribe and like the video, and I'll catch everybody in the next video.